Welcome to Retirement Roadblocks. And as the name suggests, my goal is to give you a full overview on your retirement roadblocks in as little as time as possible. Over the next 20 minutes, I'm going to walk you through the major financial risks that can disrupt even the most well-funded retirement. For most people watching this, the challenge is not simply accumulating enough money. It's understanding how taxes, inflation, market loss, healthcare costs, longevity, and income decisions can affect the wealth that you've already built. By the end of this presentation, you'll have a clear understanding on the risks that you should be preparing for, the questions that you should be asking, and whether your current retirement strategy may need a closer look. Now, you may not have every solution in place here today, but you'll know what to look for, and you will not have to navigate this alone. Now, to briefly introduce myself, my name is Joe Brandau, and I've spent more than a decade in this industry, both working with clients like yourself and to help train agents and agencies on how to design and place retirement cases. Through my role as a field marketing organization, I personally work with more than 120 insurance carriers today, within a distribution network representing more than 700,000 downline relationships. Now, what that means for you is that my perspective is not limited to one insurance company, one product, or one way of approaching retirement. I'm often the person that agents come to when they need help to compare strategies, design a case, or to help determine how to properly address a client's needs like yourself. I entered this industry because I enjoy help people understand complicated retirement decisions, especially when those decisions involve money that they've spent decades to build. My goal here today is to take what I've learned and to make it as clear and as useful as possible. Now, I believe that an informed client is a good client, a better client. And my years of helping retirees and pre-retirees navigate the twists and turns of their retirement journey, experience has taught me that most retirees will face few, if not all, of these 7 major retirement roadblocks in their retirement. And because those roadblocks could potentially expose your retirement to unnecessary obstacles, I often refer to these as financial risks. The good news is that the sooner that you're aware of these potential risks, the sooner that we can help you implement strategies to help avoid them. So, what are the 7 major retirement risks that you could face in your retirement? They are longevity, inflation, sequence of returns, withdrawal rate, Social Security, healthcare, and taxes. Now, at the end of the presentation today, we're going to have a quick quiz. You'll be given 7 questions, all yes or no responses, but don't worry, no one can fail, and we'll have that quiz at the end today. To help guide our retirement discussion today, let me introduce you to 2 siblings, Bill and Jill. As we join Bill and Jill on their retirement journey, we will soon see them face the 7 retirement roadblocks. The first financial risk Bill and Jill will face in their retirement journey is longevity. Longevity, I would argue, is perhaps the single most important risk that retirees face. To illustrate this issue of longevity, how many of you here have heard of Hester Ford? In August of 2020, Hester Ford was confirmed to be one of the oldest living Americans in the United States. At 115 years young, the delightful Hester could be found living out her retirement years in Charlotte, North Carolina. What's fascinating is in the United States today, there are 101,000 Americans who are over the age of 100 or older. And that's expected that number of centenarians will reach over 400,000 in just 30 years. Now today, Americans are living longer than ever, resulting in retirement that could last 25, 30, or even 40 years. Now let's take a look at some of the stats. We know that if we have a 65-year-old couple, there's a 50% chance that men will age 89 and a 50% chance that women will reach 90. That means that half of the 65-year-olds will live even longer. Now, in fact, 1 in 4 will live in the mid-90s and 5% will live to ages 100 or more. The reality is that we're living longer, and retirement for many of us could be much longer than we ever anticipated. My guess is that Hester probably could never have contemplated the fact that she'd be in retirement for 40 or even possibly 50 years. Now, earlier I said that living longer is the most important risk to facing retirees. Why? Because if you live longer, it's a multiplier of all the other retirement risks. The longer you live, the more likely market risk, inflation, long-term care, just to name a few, are going to impact your retirement. Now, let's take a look at inflation. Now, if you're one of many retirees on a fixed income, inflation or loss of your purchasing power is one of the greatest risks to your retirement income. Inflation is simply a risk of the cost of goods and services over time, but because it can increase gradually, inflation can sometimes be a risk that goes unnoticed. In periods of high inflation, like the mid-1970s and the early 1980s, consumers were painfully aware of the strain on their wallets. For example, back in 1979, inflation was at 13%. During that time, 30-year mortgage rates hit 12%. The noticeable impact of inflation was unmistakable. And I think everyone here remembers just how bad the 6 to 8% felt like in our recent pandemic. We all know that high inflation is bad, but even modest rates of inflation can have a cumulative effect. Over the past 20 years, we've been experiencing a relatively low inflation rate, so it's gone mostly unnoticed. As a result, inflation is still there, compounding over time. It's just taking longer than ever to take away from our purchasing power. Now, keep in mind, the historical average is 3.2%. So while the recent 20-year average is only 2.5%, it's likely that those rates will eventually move closer to our historical average. And so when we look at a retirement income, we need to find strategies that are designed to provide increasing income to help address this rising cost of inflation. Now let's take a look at an example. If you had $50,000 a year in income today at a relatively modest 3% inflation rate, your income will need to be doubled in 24 years. Think about it. Your $50,000 today needs to become $100,000 in 24 years. But in periods of maybe higher inflation, let's say 6%, $50,000 now needs to become $100,000 in 12 years. That means it needs to be doubled in half the time. So think about Hester for a moment. After a long, extraordinary life, she passed away in April of 2021, living more than 30 years in retirement. Even at a modest 3% inflation rate, Hester's income had to not just double more than once, but twice during her retirement just to maintain her purchasing power. So whether it's high inflation or low inflation, the longer we live in retirement, the more important it becomes to create strategies designed to help maintain your purchasing power so you don't potentially deflate our ability to cruise through retirement. Now, we often rely on our retirement assets to outpace inflation. However, we all know that markets are unpredictable. They go up and they go down. Typically, market pullbacks will have minor impact on your retirement savings because we simply wait for the market to recover. However, when a market pullback occurs early in your retirement, they can have some of the major impacts, making it very difficult for portfolios to bounce back to provide you the income needed throughout your retirement. We call this a sequence of return risk or sequence risk. What's frustrating about risk is based solely on the luck of what's happening in the market when you retire. You can't control or predict it, but its impact in your retirement nest egg can be very significant. Let me demonstrate now on how timing in retirement can be everything. Let's take a look at Bill and Jill. Bill did very well in his retirement, and when he reached his retirement age of 1996, he accumulated $1 million in retirement. And when he started his first year of retirement, started withdrawing 4% every year. Now let's take Jill. Jill, just 3 years younger, she followed her brother's same footsteps, also accumulating 1 million, withdrawing 4%. The only difference is Jill retired in 1999, 3 years later than her brother. Now let's go back to Bill. He started withdrawing 4% each year, adjusted for inflation. By the year of 2022, he withdrawed a total of 1.6 million. And his residual account value increased to over 2.3 million. Bill's retirement plan is looking pretty good, right? Well, how about his sister? Jill retired in 1999, withdrawing the same 4% each year, adjusted for inflation by the end of 2022. Her total would have been withdrawal at about 1.3 million. That's about 300K less. But her total account value fell to zero. That's $2.3 million less than her brother. So what happened? Well, Bill in 1996 experienced 4 years of positive returns before having to weather two strong bear markets, the 02 and 08. Bill simply had more time for his savings to grow before those negative return years hit. But now let's take what happened to Jill. Jill, however, retired in 1999 and only had 1 year of positive returns before the bear markets hit. Jill fell victim to sequence of risk. Now, the only thing Jill did differently here was retired 3 years later, giving her a different sequence of market returns. Now, as you can see, the effects of sequence of return make it really hard to plan for your retirement. We can't predict what the market's going to do or when. And due to this level of uncertainty, many people are looking for guarantees. And if you're one of these people that want to take secret of the risk return exposure off the table, we have strategies that can help. Now, because market volatility, researchers back in 1990 started asking the question, how much money can you safely return out of each portfolio each year so that your portfolio can last throughout your retirement? We call that a safe withdrawal rate. In 1999, a financial expert told us that based on the historical data, 4% is the safe annual withdrawal rate. Now, 3 years later, today's researchers tell us that the 4% rule is more like a 3.3 or 2.8. Now, depending on how you divide your retirement savings and how long you'll be in retirement. Even if we were to take that high of 3.8%, that means your portfolio may only last 25 years, which means you may run out of money at some point in your retirement. In other words, they're telling us that we need to withdraw significantly less out of our portfolios each year if you're looking to generate income throughout your retirement. So if the recommended annual withdrawal rate today is nearly half of what it's been historically, moving from 4% down to 2.9, that means that your nest egg will now need to be significantly larger. Let me show you. To generate $40,000 a year in income using a 4% safe withdrawal rate, you'll need to have a $1 million portfolio. Well, let's take consideration 3% withdrawal rate. You'll need to now have 1.3% more in savings or 1.3 million to generate that same $40,000 in income. While this news is sobering, the good news is there are various financial and insurance strategies that can help create sustainable lifetime income. When we meet to discuss your unique financial factors, we'll explore the safe withdrawal rate that might be right for you. Now, speaking of guaranteeing lifetime income, Social Security is one of the few sources of guaranteed income for retirees. Because it's so vital, it's very important to thoroughly understand your options to optimize your benefits. Determining how and when you're going to file for your benefits can be quite complex. There's a surprising number of options to consider, and the choices that you make could not only significantly impact your retirement income, but your spouse's or your surviving spouse's income as well. There are a few things to know. You can start receiving your Social Security benefits as early as age 62. However, you're entitled to 100% of your benefits when you reach your full retirement age. What happens frequently, though, is people start pulling their benefits before reaching that full retirement age, which may not be the best option. The decision to begin your benefits prior or after your full retirement age can permanently decrease or increase the benefits dramatically. Now let's take a look at Bill and Jill. They both have a full retirement age of 66 and will be entitled of $2,000 per month. If Bill were to retire and take his Social Security benefits early at the age 62, he's going to experience 25% reduction in his benefits. $2,000 now becomes $1,500 per month. Now, on the other hand, if Jill waits until age 70, she's going to receive what's called a delayed retirement credits, and her check is now going to be increased by 32%. So at age 70, she is going to start receiving $2,640 per month. That's a significant difference between the two of them. To put it another way, due to Jill's delayed retirement credits, her total lifetime benefits will amount to almost $130,000 more than Bill's. Since Social Security is most likely one of the few sources of guaranteed lifetime income for people, when we meet, we can explore your Social Security filing options so that you can make a strong decision about when and how to file for your income benefits. Of all the risks that we outline, healthcare is probably the most significant and difficult risk that we can plan for. Now, what do I mean by that? As we age, our out-of-pocket costs go up. And as a result, a healthy 65-year-old couple can expect to spend over $14,000 a year in annual out-of-pocket cost. And by the age of 85, the number triples to $45,000 a year. Now, why is there such an increase in out-of-pocket healthcare costs? You remember Hester Ford? At age 115, she was living most of her retirement independently in her own home. But after dementia, she was experiencing increased healthcare costs. Her daughter stepped in to help provide additional home care. The irony here is her daughter is 87 years old. At age 115, she began getting cared for by her 87-year-old daughter. Like Hester, many families, including my own, opt to explore in-home healthcare options due to the high cost of long-term care. The research shows that nursing home care costs is approximately $7,000 to $8,000 per month, and assisting living homes approximately $3,600 a month. Now, if we look at the national median cost for private in-nursing home, it amounts to about $92,000 annually. Many of us don't plan for those healthcare costs, but the financial cost of not planning for that risk can be devastating. Now, the last risk we're going to talk about today is our old friend, taxes. Taxation is one of those risks that we can't plan for proactively. Like Robert, best-selling actor of Rich Dad, Poor Dad said, it's not how much you earn, it's how much you keep that matters. And taxation really speaks onto that. How many of you here have IRAs or 401ks as your largest retirement savings? Now, when you withdraw those assets, they become taxable income. So you may have $1 million in your 401k, but will take significantly less after you pay taxes on those withdrawals. The issue with taxation is the future of taxes is uncertain. The reason? Well, in just May of 2025, the United States had $36 trillion in debt, spending $950 billion just to pay the interest on that debt. Now, today, taxes are still relatively low, but in order to balance the budget, there's only two options. You can either decrease spending or increase taxes. Now, how many people here believe that the government is going to start spending less? Considering the last 60 years, the federal spending has only gone down 4 times. If the government were to increase taxes, we want to ensure that we have different sources of retirement income so that we can pivot should those tax rates change. We call that tax allocation. Tax allocation looks at taxable, tax-free, and tax-deferred saving vehicles. Tax allocation is important because it will give you the flexibility depending on whether we are in periods of high tax rates or lower tax rates. For example, if tax rates go up and most of our retirement assets are in tax-deferred traditional 401ks or IRAs, once withdrawn, our after-tax income will be less. But with tax allocation, if tax rates go up, we could pull our income from other sources of more tax-efficient vehicles like a Roth IRA or life insurance that is not impacted on tax rate changes. As I mentioned, of all the risks, taxation risk is one that we can plan for proactively. When we meet, we can determine if you're actually taking advantage of tax-efficient vehicles in your retirement income strategies to prepare for whatever the future may hold, and your risk tolerance. Now, today, we discuss the major roadblocks of financial risk to avoid in your retirement. In any retirement journey, the key is not to go in alone. As a financial professional, I help clients navigate the financial risk every single day. I can help you build a retirement income strategy designed to address each one of the financial risks that's discussed today, whether it includes addressing potential changes in taxation, optimizing for Social Security benefits, reviewing ways to change market volatility. My goal is to help you build a customized retirement plan based on your time horizon, income goals, and your risk tolerance. Lastly, and certainly not least, remember, Hester experienced 50 plus years in her retirement. That's a good reminder that retirement is a long-term venture. You must keep a long-term perspective as well as a trusted financial professional to help keep your emotions in check to not fall victim to the latest news cycle. I'm here to keep your eyes on the ball and help you navigate the 7 retirement roadblocks. Now that we've gone through the material, since you've made it this far, to save you time, you'll be sent these questions. But ladies and gentlemen, understanding these retirement roadblocks is important, but the real value comes from seeing how they apply to your income, your accounts, and the wealth you've spent years to build. And that's what we'll do on your first call together. Below this presentation, you'll see a button that says Schedule My First Call. Click the button and choose the time that fits best for you. After scheduling, you'll receive a text to complete a short retirement planning intake. It'll only take about 5 minutes, and please make sure that's completed before your first call. Thank you very much for your time today. We covered the 7 major retirement roadblocks, but how they affect you depends on your assets, your income, your needs, and your goals. I look forward to learning more about you and your situation and helping you determine the right path forward.